Hello and welcome to this video about securitization. What is securitization? Securitization is a financial instrument that evolved from active credit portfolio management performed by banks. In this video we will explain the purpose, the process, and the common types of securitizations. Let's start with a brief statement to set the scene. Securitization is a financial process in which a pool of illiquid financial assets, such as mortgages, car loans, or credit card receivables, among other types, are packaged together and sold to investors in the form of securities. What is the aim of doing this? This enables the issuer, which is usually a bank or so-called originator of the securities, to convert illiquid assets into tradable financial instruments. Traditionally, banks have funded their loans predominantly from deposits. In the 1960s, U.S. banks figured that they could keep up a higher pace in terms of lending volume and velocity of mortgages with this type of funding. This led to the development of the mortgage-backed security, or so-called MBS, market, the first type of securitization of its sort. Portfolios of mortgages were created, and the cash flows, comprising of interest and principal payments, are generated by the portfolios that were packaged as securities. Thus, although banks originated the mortgages, they did not keep them on their balance sheets. Nonetheless, they could fund further loans, and as already mentioned, it allowed them to increase their lending activities faster than their deposits were growing. Stating this, let's sum up the advantages of securitization. Improved liquidity. To reiterate once more, by securitizing illiquid assets, such as mortgages or car loans, financial institutions can convert them into tradable securities, which can be sold to investors. This improves liquidity and provides a way to generate further funds. Risk management. Securitization enables financial institutions to transfer the risk associated with a pool of assets to investors, reducing the risk or risk-weighted assets on the institution's balance sheet. Furthermore, if we look at the advantages on the investor's side, we can claim the following. Diversification. As we will see, the packaged assets are rated and sliced into tranches. Investors can purchase securities in different tranches with different risk profiles, enabling them to diversify their investments. This goes hand in hand with the demand in regards of the risk and return appetite of investors. The structure of a securitization transaction can be customized with respect to tranches to meet the needs of different investors and issuers. Different tranches represent different risk and return levels. That means, tranches that have a low probability of default are less risky, and therefore, lower interest is collected by the investor. Same is true vice versa. If the probability of default is higher, the investor receives a higher risk premium. That means the interest payments are higher if invested in those tranches. Starting in the 1980s, the securitization techniques developed for the mortgage market were also applied to asset classes such as automobile or car loans and credit card receivables in the United States, as well as securitization also become popular in other parts of the world. As the securitization market developed, investors became comfortable with situations where they did not have a guarantee against defaults by borrowers. This brings us to the disadvantages of securitization. Complexity. The process of securitization can be highly complex and involves multiple parties, including originators, servicers, and investors. Furthermore, once packaged assets can be repackaged, adding another layer of complexity and thus grasp of the financial product as such. This brings us also to the next point. Lack of transparency. The underlying assets in a securitization transaction can be difficult to value, and the cash flows generated by those assets can be affected by changes in interest rates or other factors. For example, increases in the interest rates entail lower valuations in the terms of the present value. The originator of the assets may have an incentive to take on more risk if it knows that it can transfer that risk to investors through securitization. This is called moral hazard, which leads on a more global scale also to systemic risk. The securitization of subprime mortgages was a major contributor to the global financial crisis of 2008, highlighting the potential for systemic risk associated with securitization, since severe defaulting of loans led to financial instability, and this can bring whole economies on the brink of collapsing. To briefly sum up, securitization has become an important tool for financial institutions to manage risk and generate liquidity. However, it has also been associated with the global financial crisis of 2008, as the practice of bundling and selling subprime mortgage loans in complex securitized instruments was a major contributor to the collapse of the housing market and the subsequent financial crisis. A more thorough evaluation of this will be presented in the follow-up video, where we reference to at the end of this video. Alright then, let's move on and delve a bit more into the basic types of securitizations. Since we are now familiar with the basics of securitization, let's focus next on the assets that can be securitized. Or in other words, the main types of securitizations comprise the following. Asset-backed securities, whereas the respective abbreviation is ABS. ABS are securities backed by a pool of financial assets, such as credit card receivables, auto loans, or leasing claims. Mortgage-backed securities, or MBS. MBS are a type of ABS that are backed by a pool of mortgages. These comprise of residential mortgage-backed securities and commercial mortgage-backed securities, as well as collateralized loan obligations. CLOs are a type of CDO that are backed by a pool of bank loans, such as leveraged loans or commercial real estate loans. Collateralized debt obligations, or CDOs. CDOs are securities backed by a pool of debt instruments, such as securitized portfolios in more general terms or collateralized bond obligations. The debt instruments are typically divided into different tranches with different risk profiles. Since the assets are traded on exchanges, it is easier to evaluate their default risks. Last but not least, credit default swaps, or so-called CDS. CDS are derivatives that allow the banks or the originator to transfer the risk of default of a specific asset via an SPV to another party or investor in the wider sense. That party is reimbursed for taking that default risk. The actual loan, subject to default risk, remains on the balance sheet of the bank or originator. Accordingly, the assets are not transferred. This is a so-called synthetic securitization. Any other type that had been discussed beforehand is being labeled as real or true sale securitization. These are the main basic types of securitizations. However, there are many others, as well as you may have noticed that some of them have overlap in terms of their categorization. If you are more interested in the topic of securitization, we can recommend you watching the follow-up video Securitization, Process and its Role in the Great Financial Crisis. See you there and keep in touch. Thank you for watching.